Grug has 1,200 teeth to invest. Grug remembers the investing video. Broad index funds, long time horizon, the boring approach that beats most professionals. But Grug also thinks prices change every day. Some days the market is up, some days it's down. Surely it makes sense to wait for a day when prices are low and invest then, rather than just investing today at whatever today's price happens to be. Grug waits, watches prices. 1 week, prices drop slightly. Grug thinks, good, but maybe they'll drop more. Grug waits further. Prices rise back up, past where they started. Grug thinks, missed it, now waits for another dip. Another dip comes. Grug hesitates again. What if this isn't the bottom either? What if waiting a bit longer gets an even better price? 3 months pass. Grug has done this dance repeatedly. Waiting, almost acting, hesitating, watching prices move past the point where Grug almost acted. The 1,200 teeth are still sitting, uninvested in cash, which is itself losing purchasing power while it waits. Grug realizes something. Grug has been trying to identify the low point, the single best moment to invest out of all possible moments. And Grug has absolutely no way of knowing on any given day whether that day is the low point or not. The only way to know a low point was a low point is by seeing what happens after it, at which point it's no longer available. Today Grug explains dollar cost averaging, an approach that doesn't require knowing the unknowable with genuine advantages of its own. Let Grug start with why buy low, sell high, while obviously true as a statement, is nearly impossible to execute consistently. In hindsight, there were clearly moments that were lower. But today, Grug doesn't have access to the future part of the chart. Today's price could be a local low about to rise, or it could be a local high about to fall further. There is no way to know. Even professional fund managers with enormous resources fail to consistently time markets. This isn't a skill gap. The information simply doesn't exist yet. Grug's 3 months of waiting were the natural result of trying to solve a problem that has no solution, identifying the low point in real time. Now dollar cost averaging. Let Grug explain the mechanism. It's genuinely simple, which is part of the point. Instead of trying to find the single best moment to invest a lump sum, dollar cost averaging means investing a fixed amount at regular intervals, say, the same amount every month, regardless of what the price happens to be at each interval. That's the entire mechanism. No analysis of whether now is a good time, no waiting for dips, no watching charts. The same amount on a schedule. Now, here's why this isn't just giving up on getting good prices. It has a mathematical property that's genuinely useful. When prices are lower, a fixed amount of teeth buys more units, more shares, more of whatever's being invested in. When prices are higher, that same fixed amount buys fewer units. Over time, this means more units get purchased during lower price periods and FEWER units during higher price periods automatically without any analysis. Grug works through a simple example. Investing 100 teeth per month for 4 months with prices of 10, 8, 10, and 12. Month 1, 100 teeth at price 10 equals 10 units. Month 2, 100 teeth at price 8 equals 12.5 units. Month 3, 100 teeth at price 10 equals 10 units. Month 4, 100 teeth at price 12 equals 8.33 units. Total invested, 400 teeth. Total units, 40.83. Average price paid per unit, 400 divided by 40.83 equals approximately 9.80. Notice, the simple average of the 4 prices is 10, but the average price Grug actually paid per unit was 9.80 lower than 10. This happened because more units were bought during the month with the lowest price than during the month with the highest price. This is the core mathematical benefit. Dollar cost averaging tends to produce an average cost per unit that's lower than the simple average of the prices. Now Grug addresses the psychological dimension because this matters as much as the mathematics and connects directly to the psychology of money video. Trying to time the market creates a specific ongoing psychological burden. Every day, the question, should I invest now or wait, is technically still open. This is exhausting, and as Grug experienced directly, can lead to months of inaction during which the money sits in cash, not growing. Dollar cost averaging removes this question entirely. The schedule says, invest today. The amount is fixed. There's nothing to decide, no analysis to perform. The decision was made once when the schedule was set up, rather than needing to be made fresh under uncertainty over and over. This connects to the loss aversion and present bias Grug covered earlier. When markets are falling, lump sum thinking creates a strong urge to wait. Often this means waiting through the entire recovery because the bottom is never identifiable in real time, only afterward. With dollar cost averaging, a falling market during a scheduled investment isn't a reason to hesitate. It's simply a month where the amount buys more units. The schedule continues regardless, and the mathematical benefit Grug demonstrated is actually largest during periods of higher volatility. More extreme highs and lows mean more units bought during the lows, and the gap between average price and average cost paid widens. This means dollar cost averaging isn't just a way to avoid the psychological trap of market timing. It's an approach that specifically benefits from the volatility that makes timing attempts so psychologically difficult in the first place. Now Grug addresses a fair question. Is dollar cost averaging always better than investing a lump sum immediately if the lump sum is available right now? Grug wants to be precise here because the honest answer is nuanced. If Grug has a lump sum available today and compares invest it all today versus spread it out via dollar cost averaging over the coming months, research on this generally finds that, more often than not, investing the lump sum immediately produces a better result, simply because markets have historically trended upward over long periods, and more time invested tends to outperform less time invested on average. So why does Grug still find dollar cost averaging valuable? Because the comparison above assumes the lump sum is sitting there, fully decided, with the only question being all at once or spread out. In Grug's actual situation, and in the situation of most cave people, money doesn't arrive as a single lump sum sitting in wait. It arrives gradually, as income, over time a paycheck, a season's earnings. Dollar cost averaging, in this far more common situation, isn't spreading out a lump sum that could have been invested immediately. It's simply investing each portion of income as it arrives, which is the only option available since the later portions don't exist yet. For this situation, which describes most ongoing investing, as part of the pay-yourself-first approach, dollar cost averaging isn't really a choice being made. It's simply what investing from income looks like by necessity. The mathematical and psychological benefits Grug described apply fully here, and there's no real alternative being given up, since the alternative would require having money before it's earned. Where the lump sum question becomes relevant, situations where a genuine lump sum does appear, an inheritance, a large bonus, proceeds from selling something. In this specific situation, Grug acknowledges the research generally favors immediate investment over spreading it out, though Grug also notes that for some people, the psychological comfort of easing into a large lump sum may be worth it if it prevents the kind of paralysis Grug experienced at the start of this video, where the alternative was months of complete inaction. Grug's summary on dollar cost averaging. Buy low, sell high requires knowing, in real time, which moments are low and high, information that only exists in hindsight, which is why even professionals largely fail at consistent timing. Dollar cost averaging fixed amounts at regular intervals produces an average cost per unit that's typically lower than the simple average price, because more units get bought automatically when prices are lower. This approach removes the exhausting, ongoing should I act now question and specifically benefits from the volatility that makes timing attempts so psychologically difficult. For most ongoing investing, money arriving as income over time, dollar cost averaging isn't a choice. It's simply what investing from income looks like. For genuine lump sums, immediate investment is generally favored by the math, though gradual investing may still have psychological value for some. Grug's 1,200 teeth, after 3 months of watching and waiting and hesitating, finally got invested, not because Grug found the perfect moment, but because Grug stopped looking for one. Grug set up a schedule. Same amount every month, regardless of what the price chart looks like. Grug doesn't check the chart before investing anymore. Grug checks it sometimes out of curiosity, but never to decide anything. The decision was already made. It gets made once, and then it just runs. Next video. Grug discovers the 1% rule. Tribe thinks small changes are too tiny to bother with. Grug finds out tiny repeated is exactly how enormous things get built. Do not miss it.